Hello and welcome to Martyn Lucas Investor. My name is Sensei and we are here to watch Jerome Powell's speech. This is the most important speech from Jerome Powell since the Jackson Hole event, and many of you remember what happened at that event. You might not have been there to witness it. We were covering it live, but you would have seen the effects. Jackson Hole's speech about a month ago, a couple months ago now, Jerome Powell came out and said he will be cutting rates. He didn't say it directly like that, but we knew in the language he used. He said he's concerned about the jobs market. He said he's going to fix that problem. We knew what he meant. That meant he was going to start cutting rates. That led us to one of the most parabolic rallies we've seen in the S&P 500 over the last 5 years. Now that leaves us at the highest valuations we've seen on the S&P 500 since the dot-com era. So is Jerome Powell going to give us the fuel to keep the rally moving? Is he going to allow the S&P 500 to continue going higher? Is he going to confirm the 3 rate cuts we are expecting? Is he going to allow rate cuts to continue? Well, we're going to find out in today's live stream. Whether you're watching it live or later, Jerome Powell is going to be speaking in the next half an hour live on the show. We've got the speech. We are ready for it. We're going to get ready with the analysis. Firstly, we've got all the things we're waiting for, all the analysis that you need to, know. Someone's saying live stream, we don't see you. You should be able to see me. Everything should be fine. If you've got an issue, please refresh the stream. We've got the analysis, so we understand what to look out for, what he's going to say, what's important to see in the speech. We are prepared with the live stream. We are ready, waiting for Jerome Powell to take the stage. I am going to put the timer on the screen so all of you know exactly when Jerome Powell is going to be speaking. Let me put that on the screen for you now. So the speech will be starting, and I'll put the countdown exactly there. That's the time, in about 27 minutes time. That gives us time to get prepared. The markets are going to be getting ready for this as well. If I put the S&P 500 on the screen, we can see we were down very heavily this morning, and now we are only down 0.11%. The market is rallying into the speech. Well, what does that mean? Does that mean they're buying it to sell it off? Or does that mean someone has the information that Jerome Powell is going to be confirming those rate cuts? Are we going to see rate cuts? Are we going to see Jerome Powell come out and give us indication of which way he wants to go? If he wants to start holding it, if he's concerned about inflation, if he's going to start cutting rates because of the job market, like he said at the last event, and then the markets rallied 10, 20, 30%, and the crypto markets rallied even more. Are we going to get that, or are we not? Remember, Jackson Hole event was the biggest event from Jerome Powell we've seen. The last big event we've seen from Jerome Powell. We've also got another reason to really care about this event, and that's because the FOMC meeting, which we are expecting a rate cut for now, this could all change, is on the 29th of October. After this speech, we're not going to hear from Jerome Powell until that date, the 29th of October. The next time we're going to hear from Jerome Powell is at the FOMC meeting. So whatever he says today is going to stick in the market, and it's going to take us wherever his speech indicates for the next 2 weeks, because this is all we have to go off until the official FOMC meeting. We don't have any data to go off. We're not getting data. We haven't got CPI data. We haven't got jobs data. So that's not going to indicate where we go. It's going to be what Jerome Powell says in this speech. So, as always, I don't give financial advice. This is my thoughts and opinions only. Please do not buy or sell based off anything I say. That would be a very unwise decision. If you have just tuned in, one favor I always ask of you, and it's free. It takes a second. Please do hit that like button. Just take 1 second. Literally, drop what you're doing right now. You can do it on your TV. You can do it on your computer. 1 second. Take your thumb and press the like button. It takes literally a second. And if you haven't done so already, please do subscribe. Let's get into the deep dive of today. Let me give you all the information you need to know before this speech commences in the next half an hour. Now it's 25 minutes from now that speech commences. Remember, we are waiting for that to go live. We've got it all set up for you. We are going to keep an eye on the markets as well. The S&P 500 rallying into this. Gold recovered from going a little bit negative today, now up 0.65%. We've got the crypto market, which is quite red today, which we can expect. Bitcoin is now breaking out, trying to put in new highs. All relies on this Jerome Powell speech. People are buying into the speech. So we are going to unpack what this speech is all about, what to look out for, why it's important, with today's deep dive brought to you by Sensei's Insights, which is our very own newsletter. The first link in the description is also in the live chat. It's a free newsletter. Every single day you get all the information you need to know into your inbox. So deep dive inside Powell's dilemma. He's got no data. His Fed officials are divided. Some want pauses, some want double cuts, some want 25 basis point cuts, and also the markets are nervous. The markets are nervous as we speak. We are in a bubble, but the markets don't know when it's going to pop. So let's see. He does have a dual mandate. He has to take care of inflation. He has to take care of employment. Inflation is a little bit sticky. Unemployment is going up. We saw today, remember, I brought this story to you in our morning forecast show every single morning, where we looked at the UK, because the UK has the data, the UK is in a shutdown, and they're quite correlated. The UK jobless rate hits 3-year highs as wage growth cools. So what we saw in the UK today is unemployment climbing to 4.8%. We expect the US to follow suit as well. So that's why I expect Jerome Powell to continue to talk about the jobs data today. That would indicate if he's talking about the jobs and he's concerned about unemployment, that would show that we've got a dovish tone about cutting rates from Powell, and that should send the markets higher. If he's overly concerned, if he starts alluding to emergency rate cuts, that's when the market will crash, because that means we are too late. So let's go into today's story about Jerome Powell. We saw what the UK did today. The data came out, the pound came down, the markets didn't like it, unemployment went up. But that does mean rate cuts are going to come in the UK. Does that indicate they will come to the US as well? I think so. So dual mandate: inflation, keep inflation down, bring it to 2%. In employment, make sure there is enough employment and unemployment's not going up. It's a very simple job, but it looks like Jerome Powell might be not doing his job properly, because unemployment's going up and inflation is staying sticky. For now, that's where we are at. We are at a very fine line, because the markets don't think it's a problem yet. The markets do think it's a soft landing. They do think inflation is gradually coming down, and they do think employment and unemployment is not at a scary range yet, and that's why the markets are rallying. However, I do believe in 2026 we will get a broader market crash where we go into a recession, because one of them will fail, whether it's inflation starts ticking back up or stays too sticky, or unemployment goes up. I think that will come in 2026. I am still fairly bullish on the markets as we speak. So remember, the other undertone is here, the government shutdown. The government shutdown is hindering any data coming out. So it'll be interesting to see what Jerome Powell says about this as well. If you have just tuned in, make sure you take a second to hit that like button, subscribe if you haven't done so already. Leave a comment in the live chat as well. What do you expect? We've got a poll running as well. You've got the time right above my head. That's when the speech is starting. So stay with us as we're about to analysing it. So when the Federal Reserve Chair Jerome Powell takes the stage Tuesday at the National Association for Business Economics meeting in Philadelphia at 12:20 p.m. Eastern Time, he inherits a uniquely fraught backdrop. Remember, this is where he's speaking. He's at the National Association for Business Economics meeting. It's in Philadelphia. This is the event here. It's the 67th annual meeting, Global Economy and Transition, Finding Opportunity Amid Disruption. The next session will stand by. You can see Jerome Powell will be joining us here shortly. Let me go back to him. So the government shutdown now underway. Remember, there's quite a few things going on behind the scenes. The government shutdown, that's now underway. It has silenced the publication of key monthly data, jobs data, CPI, retail data, PPI, PCE, jobless claims, all of that we're not getting. That deprives both the markets, that's market participants such as us, and also the Federal Reserve doesn't have access to this data either. Also, the Fed has been deprived of fresh signals on growth, inflation, and labor. So that's what is one of the concerns, and it depends how Jerome Powell reacts to that information. He hasn't commented on the government shutdown yet, but I'm sure he will today. If he shows a lot of uncertainty and a lot of fear about not getting the data, and that he might not want to act without any data and keep everything where it is because he can, that might cause the market to crash. The Fed is entering its blackout window as well. This is why this is so important. What is this blackout window? Well, they don't speak to press. They don't give any insights about 2 weeks before the FOMC meeting. Remember, we are covering the FOMC meeting live on the show. That's when they officially announce if there's rate cuts or not, unless there's an emergency rate cut beforehand. But the market, before FOMC meetings, knows what's happening. How do they know? Well, they listen to speeches like this. And today we'll get that indication on what's going to happen in that FOMC meeting. So the interesting thing is, the Fed is entering a blackout window ahead of the October 28th, 29th meeting. What is that blackout window? Well, it means Powell's remarks could set the tone for roughly 2 weeks without fresh commentary. Whatever he says in 18 minutes' time, that's what's going to stick for the next 2 weeks. That's what the market's going to go off. We don't have data, probably. We won't have anything else. The Fed's not going to come out and speak. This is the final sort of speech from Jerome Powell ahead of its blackout window going into the FOMC meeting at the end of the month. And also, there's another situation in the backdrop. So, at the September FOMC meeting, the one we covered live on the show, the Fed cut rates by 25 basis points to 4 to 4.25%. And Fed projections reveal deep internal division. We looked at the Fed minutes live on the show. Remember, we're live every single day, bringing all of this information together, using the newsletter as a way to publish this information and bringing you the most up-to-date, real, unbiased information. The link is in the chat. That minutes showed us that the Fed officials, remember, many Fed officials vote on whether to cut, hold, or raise rates. What the market loves to see is all Fed officials be very clear with what they want and all on the same page. Last FOMC meeting, after we saw the minutes, it revealed that there was deep internal division. There was Fed officials that wanted to stay where they were. There was Fed officials that wanted rate cuts. There was Fed officials that wanted 50 basis point rate cuts, double rate cuts. That shows that they're not all agreeing with each other. There's problems within the Fed. The market doesn't really like to see that. They don't like to see the Fed having internal division. It doesn't show much certainty. It doesn't show the confidence, and the market likes confidence. So it'll be interesting to see if Jerome Powell comments on that. So the Fed projections reveal deep internal division. Some officials expected additional cuts this year. Others think policy is already accommodative enough. Another backdrop. Powell's prior messaging has leaned heavily on being data dependent. Remember, what does Jerome Powell always say, which we always... When's the speech, George K? There's literally a timer above my head. You don't need to ask me when the speech is. It's literally above my head. We're getting ready for the speech. The thing Jerome Powell always says, which frustrates many investors, and he always says it, so we must be very clear on it. He always loves saying he's heavily reliant and he's heavily dependent on data. So, Powell's prior messaging has leaned heavily on being data dependent. But with the data pipeline impaired, government shutdown, nothing coming out, he may need to learn more on narrative judgment and caveats. So this is going to be Powell being outside of his comfort zone. His comfort zone is data. He loves data. He goes on about data in every single speech he ever says. He always says, we're data reliant, we're going to look at the data. He doesn't have the data. He doesn't have the official data. Yes, there's other metrics they have access to that we have access to. We did our very own data release last week. But it's not the official data. He cannot lean back on the data. He cannot blame the data. He doesn't have the data. Let's see if that makes him nervous. Let's see how the market reacts to what he has to say about that. So because of all of this backdrop, because of the government shutdown, because of the blackout window coming up, because of what happened in the FOMC September meeting and the internal divisions, because of the data dependence, markets will be laser focused on which side of the Fed's dual mandate, inflation control or employment. Remember the picture up here. He needs to take care of both of these: inflation on one hand, employment on the other hand. That's the dual mandate. The markets will be laser focused on which side of the Fed's dual mandate, inflation or employment, receives more weight. That's all it's ever about. That's all you ever have to try and take away from these speeches. Does he care more about inflation? Is he more worried about inflation? Or is he going to focus on employment? Is he more worried about employment? Whichever receives more of his time, more of his words, more of his remarks, that's how Powell will go forward, and that's how the market will react. So receives more weight, and how Powell thinks the path forward should evolve given the uncertainty. So that's what we're looking for. Those two things, and let's build on that on a bit more. If you have just tuned in, the speech is in 13 minutes time. We're covering it live on the show. There's no better place to cover it. We'll answer all your questions after the event. We'll be covering it live. Make sure you are hitting the like button if you have just tuned in. It takes a second. It's free. It helps us out. It makes you feel good. You've done something good for the day. Smash that like button. It makes me happy. So there we go. Hit that like button. Subscribe if you haven't done so already. So how we expect Powell to address and how. So what we expect Powell to address. So here are the key narrative levers he may pull and what the markets will glean. So I'm going to skip through this part because it's not, so it's essentially we're looking for what would be a good speech. So a good speech for the markets would strike a balance between acknowledging risks in both inflation and growth. It leaves the door open for bad cuts, but not commit prematurely, and indicate a data-driven measured path. A bad speech would lean decisively hawkish, focusing heavily on inflation, stressing the cost of easing prematurely, or be vague and cluttered, leaving markets floundering or for direction. So let me just break that down once more, because this is probably the most important part. What the market wants is, of course, a good speech. And what does a good speech mean? A good speech would be Jerome Powell being very calm, not caring about not having data, saying it's fine, we don't need the data, we know what path everything was heading in. We're concerned a little bit about inflation and growth, but it looks like we're on a path to 2%. Inflation's coming down slowly but surely. Employment is our focus right now. If he starts talking about jobs and employment being the focus, that means we are more likely, and we're very, very confident we'll keep getting these rate cuts. So that would be a good speech. A bad speech would be if he's hawkish. If he starts really focusing on inflation, saying inflation's too sticky, we don't like how inflation's going, tariffs is going to cause more inflation. If he stresses about the cost of easing prematurely, if he's very cluttered, if he keeps talking about not having this data and he's concerned about not having data, that's when the markets will crash. This has to go perfectly because the markets are overinflated right now. The markets are way above a sensible level. They are in a bubble. You can call it a bubble, you can call it overvalued, you can call it what you want. They're not at the valuations that are safe. So this speech needs to go perfectly. If he hints at anything bad or no rate cuts, the markets will crash, in my opinion. Again, not financial advice. So, bull versus bear. How the speech could impact the market cycle. Remember, right now, we are on a great bull market. Are we going to continue being in a bull market, or are we going to go to a bear market? So, this speech can push us to, we are on the brink right now of a crash. We saw how ready the markets were to crash on Friday after one tweet. That doesn't mean the tweet caused the crash. It meant the markets were ready to crash. They needed something to explode. And it was one tweet from President Trump that sent crypto down 50 to 90% on Friday. So the markets are ready to crash. And we're pricing in for excellence. Excellence for earnings. Earnings all coming up this week, next week. We are pricing in excellence for earnings. And even if you price in excellence for earnings, we are still 10 to 20% overvalued. So you need earnings to go much, much better than expected, and the markets might go down 5%. So we are priced in for excellence right now, and Jerome Powell cannot hinder that. If he doesn't If he does come out and say something slightly bearish, we can go into a bear market. So the bull case. Let's start with the bull case. And I never like to bet against the market. If you're long-term investing in the markets, no matter what, you probably make money. So, and I'm a bull. I don't like being out the markets. If the markets go down, we've got insurance policies such as gold, silver. I'll sell that and then buy into markets. But you need
Hi,
to be.
folks.
Oh,
Please
here we
keep
go.
eating. I'm just going to make a few quick opening remarks.
Let's just.
My name is Alon Collette.
We've got the meeting
I'm a portfolio
starting.
manager at Fidelity, a longtime NABE member. Thank you very much for coming to the 67th annual meeting with the highest attendance again since post-COVID. I think I've already said that, but
Jerome
again, it's
Powell's
really
not
great to
speaking
have
yet.
you.
Let's just see
Please
what the
keep eating.
opening
We have a great
remarks are.
program for you today. You know, in thinking about what I was going to say when I got up here, I actually sit up in Canada, which again is north of us, in a city in Toronto, and I thought.
Wow, that sound is not good, is it? Well, hopefully, when Jerome Powell comes on the stage, it will be a bit better. We do have better sound. We have many sources, so we will pick the best one. Jerome Powell is not on the stage yet. Don't worry, I will keep an eye on all of this. Nope, he's not due for another 10 minutes. So I'll keep an eye on it in case anything happens. But let's go back to our analysis. I remember this is quite a large conference, so that's what that's about. So the bull case, easing confidence. So if Powell leans dovish or shows conviction that inflation is cooling, that's what we want to see. Inflation is cooling. Markets may price in a smoother, steeper cut path. That could feed into further liquidity, multiple expansions, and inflows to equities and risk assets. If he starts talking about quantitative easing as well, that would be great for the markets because that means liquidity is flowing in. Valuation support in a rare cut environment, the discount rate falls and equities valuations can stretch further, particularly growth and high beta names. Simply having clarity and a credible narrative can restore confidence in bull, reinforcing the don't fight the Fed psychology. The bear case or the risk? Sell the news reaction. As JP Morgan warned, even a well-received cut could produce a pullback if investors have had already front run it. Policy misstep. If Powell pushes hawkishly or signals that cuts may be scarce, equities will reprice for flatter path, compressing multiples. Overconfidence, complacency risk. A dovish tilt might further fuel everything rally. Mania extending valuations into dangerous territory. So we do want dovish, but remember, we are already overvalued. But if we do have a dovish tone, we can continue this rally. Remember, I've always said, at the end of a bubble, if you want to call it a bubble, you get the euphoric period, and that's when the markets really pump. We might get it, we might not get the euphoric period. I think we will. Historically, Fed rate cuts don't always align neatly with equity cycles, as the CFA institution notes. In many past episodes, the Fed started cutting before a recession, and equity performance after cuts has been mixed depending on context. Still, the Fed can kill a bull market if it hikes too aggressively or fails to provide sufficient easing when needed. They can kill this bull market if they do not continue to cut rates. So let me just have another look over at a few places. Let's
team, Jay Bryson's team. Jay recently retired and
Nope, they're talking about boring stuff. That remember, Jerome Powell speaks after this guy. They're not talking about anything significant. This is our Electrum event from Sunday. If you do want to become an Electrum member, you will get all the perks and benefits of silver, bronze, plus Electrum. It's our most premium plan. No, sorry, it's not our most premium plan. It is a premium plan, but a lot of it is at our cost. So do consider becoming a Electrum member. The link to upgrade your membership or become a member is there. You get the access to the trivia nights. You get access to chart requests. We give away a few prizes on the event as well. So it was a great event on Sunday. So do consider becoming an Electrum member. I'm just keeping an eye on all different sources. We're waiting for Jerome Powell to speak in about 5 minutes time. Let's just keep an eye on everything. Nothing there as of yet. Let me open this over here. Let me go to your comments for a second as well while we wait for Jerome Powell to take the stage. Just keeping eyes on all broadcasts right now. It's not Jerome Powell, so I'm just keeping that open there. Let me go back over here. Yep, no, Jerome Powell's not taking the stage yet. Let's have another look over here. Here we go. Let's see what let's just tune in for a second, see what they're talking about.
Whose terms are ending this year. So we have Wilco Schultz-Mellendorf. And then here in the room, if I could ask you three to come up, we have Kathleen Navin, Yale Selfin, and our past president, Julia Coronado.
Nope, we're waiting for Jerome Powell. So let me keep that open. We'll keep an eye on it. Jerome Powell hasn't come out yet. Remember, we are in a data drought. Jerome Powell loves his data, but he's not getting any data. He is not happy about this. Remember, the US has shut down. He's not getting any CPI. We're not getting any CPI. No PCE. Nothing of official data. Jerome Powell heavily relies on this data. He always goes on about how data is so important, but he's not getting the data. So it'll be interesting to see what Jerome Powell says about this. No monthly jobs data, CPI, retail figures, or any other hard releases until the shutdown ends. That means Powell's speech is one of the few major guideposts markets have in front of October's meeting. This is such an important speech. We'll be analyzing it after as well, because this is the only thing we have to go off, because we're not getting data. We're not getting Jerome Powell speaking again, because we're going into a data blackout and ahead of the FOMC, which we're covering later this month as well. So this is an important speech, the most important speech since Jackson Hole. Remember Jackson Hole's speech, he indicated they're cutting rates, and the market continued to go extremely overvalued and go into continue the bull market. That's what we're hoping for again today. But again, one slight thing goes wrong, the markets can crash. This could be the event that pushes markets down. If he starts talking about inflation too much, if he starts getting worried about no data, that can push the markets down. Just listen and watch. No, he's not. What's the point of watching? He's not. Even Bloomberg isn't covering it yet. We've got the early stream, and
among economists,
they're not talking about anything to do with the Fed. Remember, this is the National Association for Business Economics. They're going on all day. This has nothing to do with Jerome Powell at this moment in time. We'll be covering it in about 3 minutes' time. So watch live and after the speech. Key phrases to keep in mind: if conditions warrant, flexibility, no preset path, risk balance, all guardrails in commentary, tone towards inflation versus labor. That's the most important thing. What is he emphasizing? Does he emphasize inflation? If he emphasizes inflation, that's sort of bearish. That would be the tone that we don't want to see. That again, in the poll we are running, what do you think will happen? If he starts talking about inflation, that is a hawkish tone, and the markets could crash on that. If he emphasizes labor weakness, but not too much labor weakness, the markets would see that as dovish, and the markets can pump. There might be a Q&A segment that could be important. We've got market reaction cues as well, watcher yields, the 2-year, the 10-year treasuries, forward guidance cues as well. Does he say one more cut? We're going to pause. How many rate cuts we get? Is he going to confirm the 3 rate cuts? That's all coming up in the next 2 minutes, so we're going to keep an eye on it all. Bloomberg aren't covering this yet. We've got the early stream. They're taking pictures, so it's not important just yet. In about 2 minutes' time, we will see Jerome Powell taking the stage. If you haven't done so already, it takes 1 second. The markets are pumping into this. Please just take 1 second. Subscribe. One button. Make sure you hit the notification bell as well. That will make sure you're notified every time we do these key events. Make sure you hit the like button. It takes a second. It's free. Hit the like button. It takes 1 second. I'm sure you won't regret it. So here we go. Let's just tune into Caitlin Patrick.
Speak about them. But at this moment, and in the case of the presentation of the Adam Smith Award, I think it's more than appropriate that we take a moment to appreciate exactly who it is we're recognizing today. So Jerome Powell first took office as chair of the Board of Governors of the Federal Reserve System in February of 2018 for a 4-year term. And he was reappointed to the office and sworn in for a second 4-year term in May of 2022. He serves as chair of the Federal Open
I think
Market
she's introducing
Committee,
Jerome Powell on the stage.
Monetary policy-making body. Mr. Powell has also served as a member of the Board of Governors since taking office on May 25th, 2012 to fill an unexpired term, and he was reappointed to the board in June of 2014 for a term ending in January of 2028. Prior to his appointment to the board, Mr. Powell was a visiting scholar at the Bipartisan Policy Center in Washington, D.C., where he focused on federal and state fiscal issues. From 1997 to 2005, he was a partner at the Carlyle Group. He served as an assistant secretary and as an undersecretary of the U.S. Department of the Treasury under President George H.W. Bush, with responsibility for policy on financial institutions, the Treasury debt market,
Remember,
and related
during the
areas.
speech, I'll be going over to
Prior to joining
Bitcoin,
the Bush
XRP,
administration,
and
he
the
worked
S&P
as a lawyer and
500.
investment banker in New York City. In addition to service on corporate...
He's getting ready. Jerome Powell is about to take the stage. I will come to this screen as well. Here you can see on the right, it says Bitcoin. That's the one I'll be looking at. I'll be looking at XRP, gold, and the S&P 500.
Donated €5.99 through a super chat.
Many other
Please during
professional
THR speech comment the tone if he's dovish or hawkish. For us that are not English, thank you a lot.
Yeah, I will comment. I won't interrupt the speech too much, but you'll be able to see it on the markets. I wouldn't be trading this; it's too volatile. I'll be getting ready for the tone. I'll let you know if anything significant is said. You can see here, I'll be looking at the S&P 500. If you look at the right of the screen, you can see what I'm looking at. This one's the S&P 500. I'll be looking at Bitcoin, gold, and if any other requests come through super chats, I'll look at them as well. But now we're getting ready for Jerome Powell to take the stage. So let's tune in to Caitlin Patrick, who's introducing Jerome Powell onto the stage.
It is essential.
Take 1 second to hit the like button, 1 second to subscribe as well.
Hall of Fame. Past recipients include several Fed presidents and prestigious economists across the spectrum, including Janet Yellen and Ben Bernanke, as well as Arthur Laffer, Susan Athey, and going a little bit further back, William Poole from the Federal Reserve Bank of St. Louis, and Lawrence Klein, who won the award in 2004. We are very pleased today to be awarding this honor to Jerome Powell. Jerome Powell's exemplary leadership as chair of the Federal Reserve, especially in navigating the complexities of monetary policy during challenging times, has had a profound and lasting impact on both the U.S. economy and the global financial system. Under his stewardship, the Federal Reserve has effectively managed unprecedented economic challenges, including the COVID-19 pandemic, by taking a thoughtful and data-driven approach to monetary policy setting. His decisive actions to support economic recovery, promote financial
S&P
stability,
500.
and ensure a resilient financial system have demonstrated an unwavering commitment to U.S. economic growth and well-being. The strength of his leadership has also earned him the respect of policymakers, economists, and business leaders worldwide. His work, particularly in the areas of monetary policy, financial regulation, and economic resilience,
Can we get 105,000 subscribers?
Align with the ideals of the Adam Smith Award. He has consistently applied foundational economic principles to address real-world challenges, upholding the Federal Reserve's high standards of sound economic management and transparent policymaking in the process. So with that, I am very pleased to welcome to the stage Chair Jerome Powell. Thank you.
Here we go. Here it starts. Remember, look out for the tone. Is he going to talk about inflation? Is he going to talk about jobs? Is he going to be panicked about data? It's all starting now. Take a second to subscribe. Take a second to hit the like button. I'll be going through and commentating when I can, but we want to listen to him mostly. He's about to start talking. He's just got his award, so he's excited about that. The S&P 500 is rallying into this.
There we go. We don't have a camera.
He's won an award. I don't think anyone really cares about that at the moment. We'll be waiting to see if he confirms any rate cuts. Stay with me when the speech ends as well. We've got more analysis to do. We're going to be unpacking what he has to say. But get ready. I wouldn't be trading this. It's very volatile. People lose money when trading on volatile events. Just watch it, understand the market, and we'll come back and analyze it after to see if the bull market is going to continue or not. Here we go. The famous words, good afternoon. Let's see what happens. Jerome Powell is about to take the stage. Ladies and gentlemen, welcome, Jerome Powell.
Thank you, Emily. And thanks to the National Association for Business Economics for the Adam Smith Award. It, for me, is an unexpected honor just to be mentioned alongside many of your past recipients, including particularly my predecessors, Janet Yellen and Ben Bernanke. So thank you very much for this recognition. I will say on a more personal note, I have greatly enjoyed my regular visits to your annual meeting and your conferences. It's really been my favorite venue all these years.
S&P pumping.
It's a place. This is a place where we can talk about economic issues and not worry
What
that
happened?
someone's eyes might glaze over. I also appreciate the warm welcome I've always received here. And putting Fed staff aside for a minute, I can't think of a more lovable group of econ nerds anywhere. So thank you again for this prestigious award. And for the opportunity to speak to you here today. So, as we all know, monetary policy is more effective when the public understands what the Federal Reserve does and why. With that in mind, I hope to enhance understanding of one of the more arcane and technical aspects of monetary policy, the Federal Reserve's balance sheet. A colleague recently compared this topic to a trip to the dentist.
Quantitative easing, is that what he's saying?
I found that comparison somewhat unfair to dentists. So today I'll discuss the essential role that our balance sheet played during the pandemic, along with some lessons learned. I'll then review our ample reserves implementation framework and the progress we've made toward normalizing the size of our balance sheet. And I'll conclude with some brief
S&P
remarks on the
500
economic
likes that.
outlook. So, one of the primary purposes of a central bank is to provide the monetary foundation for the financial system and the broader economy. This foundation is made of central bank liabilities. On the Fed's balance sheet, the liability side of the ledger totaled $6.5 trillion as of October 8, and three categories account for roughly 95% of the total. First, Federal Reserve notes, that is physical currency, totaled $2.4 trillion. Second, reserves, funds held by depository institutions at Federal Reserve banks, totaled $3 trillion. These deposits allow commercial banks to make and receive payments and meet regulatory requirements. Reserves are the safest and most liquid asset
XRP
in the
pumping.
financial system, and only the Fed can create them. The adequate provision of reserves is essential to the safety and soundness of our banking system, the resilience and efficiency of our payment system, and ultimately the stability of our economy. Third is the Treasury General Account, or TGA, currently at about $800 billion, which is essentially the checking account for the federal government. When the Treasury makes or receives payments, those flows affect dollar for dollar the supply of reserves or other liabilities in the system. The asset side of our ledger consists almost entirely of securities, including $4.2 trillion of U.S. Treasury securities and $2.1 trillion of government-guaranteed agency mortgage-backed securities, or MBS. When we add reserves to the system, we generally do so by purchasing Treasury securities in the open market and crediting the reserve accounts of the banks involved in the transaction with the seller. This process effectively transforms securities held by the public into reserves, but does not change the total amount of government liabilities held by the public. So, the Fed's balance sheet serves as a critical policy tool, especially when the policy rate is constrained by the effective lower bound, or ELB. When COVID-19 struck in March 2020, the economy came to a near standstill and financial markets seized up, threatening to transform a public health crisis into a severe, prolonged economic downturn. In response, we established a number of emergency liquidity facilities. Those programs, supported at the time by Congress and the administration, provided critical support to markets and were remarkably effective in restoring confidence and stability. At their peak in July 2020, loans from these facilities totaled just over $200 billion.
He might say something about quantitative easing and buying more debt. That could push the market.
The deepest and most liquid market in the world, and the bedrock of the global financial system, was under extraordinary pressure and on the verge of collapse. We used large-scale purchases of securities to restore functionality to the Treasury market. Faced with unprecedented market dysfunction, the Fed purchased Treasury and agency securities at an extraordinary pace in March and April of 2020. These purchases supported the flow of credit to households and businesses and fostered more accommodative financial conditions to support the recovery of the economy when it ultimately came. This source of policy accommodation was particularly important as we had already lowered the federal funds rate close to zero and expected that it would remain there for some time. By June 2020, we slowed our purchase pace to a still substantial $120 billion per month. And in December of 2020, as the economic outlook remained highly uncertain, the FOMC said that we expected to maintain that pace of purchases until substantial further progress has been made toward the committee's maximum employment and price stability goals. That guidance provided assurance that the Fed would not prematurely withdraw support while the economic recovery remained fragile amid unprecedented conditions. And we maintained that pace of asset purchases through October 2021. By then, it had become apparent that elevated inflation was not likely to go away without a strong monetary response. At our meeting in November 2021,
I don't think you announced QE. It would be very
weird. At our
weird.
next meeting in December, we doubled the pace of that taper and said that asset purchases would conclude by mid-March of 2022. Over the entire period of purchases, our securities holdings increased by $4.6 trillion. So a number of observers have raised questions, fairly enough, about the size and composition of asset purchases during the pandemic recovery. Throughout 2020 and 21, the economy continued to face significant challenges as successive waves of COVID caused widespread disruption and loss. During that tumultuous period, we continued to purchase in order to avoid a sharp, unwelcome tightening of financial conditions at a time when the economy still appeared to be highly vulnerable. Our thinking was informed by recent episodes in which signals about reducing the balance sheet had triggered significant tightening in financial conditions, and we were thinking of the events of December 2018, as well as the 2013 taper tantrum. Regarding the composition of our purchases, some have questioned the inclusion of agency MBS purchases given the strong housing market during the pandemic recovery. Outside of purchases aimed specifically at market functioning, MBS purchases are primarily intended, like our purchases of Treasury securities, to ease broader financial conditions when the policy rate is constrained by the effective lower bound. The extent to which these MBS purchases disproportionately affected housing market conditions during that period is challenging to determine. Many factors affect the mortgage market, and many factors beyond the mortgage market affect supply and demand in the broader housing market. With the clarity of hindsight, we could have, and perhaps should have, stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risks. We knew that we could unwind purchases relatively quickly once we ended them, which is exactly what we did. Research and experience tell us that asset purchases affect the economy through expectations regarding the future size and duration of our balance sheet, so that when we announced our taper, market participants began pricing in its effects, pulling forward the tightening in financial conditions. Stopping sooner could have made some difference, but not likely enough to fundamentally alter the trajectory of the economy. Nonetheless, our experience since 2020 does suggest that we can be more nimble in our use of the balance sheet and more confident that our communications will foster appropriate expectations among market participants, given their growing experience with these tools. Some have also argued that we could have better explained the purchases, the communications will foster support and then sustain smooth market functioning and to help foster accommodative financial conditions. Over time, the relative importance of those objectives evolved with economic conditions, but the objectives were never in conflict. So at the time, this issue appeared to be a distinction.
Switching over to Bloomberg, they've just gone live.
That's not always the case, of course. For example,
better visual and audio.
Banking stress led to a sizable increase in our balance sheet through lending operations. We clearly differentiated these financial stability operations from our monetary policy stance. Indeed, we continued to raise the policy rate through that time. Turning to my second topic, pardon me. Our ample reserves regime has proven highly effective, delivering good control of our policy rate across a wide range of challenging economic conditions, while promoting financial stability and supporting a resilient payment system. In this framework, an ample supply of reserves ensures adequate liquidity in this banking system, and control of our policy rate is achieved through the setting of our administered rates, interest on reserve balances, and the overnight repurchase rate. Reverse repo rate, rather. This approach allows.
We're going back to the original one. Bloomberg have only got one microphone working.
And control of our policy rate independently of the size of the balance sheet. And that's important given large unpredictable swings in liquidity demand from the private sector and significant fluctuations in the autonomous factors affecting reserve supply, such as the TGA. This framework has proved resilient whether the balance sheet is shrinking or growing. Since June 2022, we've reduced the size of our balance sheet by $2.2 trillion, from 35% to just under 22% of GDP, while maintaining effective interest rate control. Our long-stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserves conditions. We may approach that point in coming months, and we are closely monitoring a wide range of indicators to inform this decision. Some signs have begun to emerge that liquidity conditions are gradually tightening, including a general firming of repo rates, along with more noticeable but temporary
Markets are
pressures on
pumping right
selected
now. He
dates.
might announce QE,
The
but we
committee's
don't know yet.
plans
I don't think
lay
so.
out a deliberately
Nothing
cautious
bearish
approach to
yet.
avoid the kind of money market strains experienced in September 2019. Moreover, the tools of our implementation framework, including the standing repo facility and the discount window, will help contain funding pressures and keep the federal funds rate within our target range through this transition to lower reserve levels. Normalizing the size of our balance sheet does not mean going back to the balance sheet we had before the pandemic. In the longer run, the size of our balance sheet is determined by the public's demand for our liabilities rather than by our pandemic-related asset purchases. Non-reserve liabilities currently stand about $1.1 trillion higher than just prior to the pandemic, thus requiring that our securities holdings be equally higher. Demand for reserves has risen as well, in part reflecting the growth of the banking system and the overall economy. Regarding the composition of our securities portfolio, relative to the outstanding universe of Treasury securities, our portfolio is currently overweight longer-term securities and underweight shorter-term securities. The longer-run composition will be a topic of committee discussion. Transition to our desired composition will occur gradually and predictably, giving market participants time to adjust and minimizing the risk of market disruption. Consistent with our longstanding guidance, we aim for a portfolio consisting primarily of Treasury securities over the longer run. Some have questioned whether the interest we pay on reserves is costly to taxpayers. In fact, that is not the case. The Fed earns interest income from Treasury securities that back reserves. Most of the time, our interest earnings from Treasury holdings more than cover the interest paid on reserves, generating significant remittances to the Treasury. By law, we remit all profits to the Treasury after covering expenses. And since 2008, even after accounting for the recent period of negative net income, our total remittances to Treasury have totaled more than $900 billion. While our net interest income has temporarily been negative due to the rapid rise in policy rates to control inflation, this is highly unusual. Our net income will soon
He will
turn
come on
positive
to
again,
today. He's
as it
talking about
typically
the
has been
past
throughout
right
our
now.
history.
He will come on
Of
to what he
course,
has to say today. So stay tuned. We're going to analyze it after. Take 1 second to hit the like button, subscribe if you haven't done so already. He's talking about the past, quantitative easing. He might announce some today. Then we're going to hear about him talk about inflation and jobs. So stay with us. He's talking about the past. He'll come on to the future.
For rates, the stance of monetary policy would no longer be appropriately calibrated to economic conditions and would push the economy away from our employment and price stability goals. To restore rate control, large sales of securities over a short period of time would be needed to shrink our balance sheet and the quantity of reserves in the system. The volume and speed of these sales could strain Treasury market functioning and compromise financial stability. Market participants would need to absorb the sales of Treasury securities and agency MBS, which would put upward pressure on the entire yield curve, raising borrowing costs for the Treasury and private sector. Even after that volatile and disruptive process, the banking system would be less resilient and more vulnerable to liquidity shocks. The bottom line is that our ample reserves regime has proven remarkably effective for implementing monetary policy and supporting economic and financial stability. So I will close with a brief discussion of the economy and the outlook for monetary policy.
Here we go.
Although some important government data have been delayed due to the shutdown, we routinely review a wide variety of public and private sector data that have remained available. We also maintain a nationwide network of contacts through the reserve banks who provide valuable insights, which will be summarized in tomorrow's Beige Book. Based on the data we do have, it's fair to say that the outlook for employment and inflation does not appear to have changed much since our September meeting 4 weeks ago. Data available prior to the shutdown, however, show that growth in economic activity may be on a somewhat firmer trajectory than expected. While the unemployment rate remained low through August, payroll gains have slowed sharply, likely in part due to a decline in labor force growth due to lower immigration and lower labor force participation. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. While official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue their downward trajectories. Meanwhile, 12-month core PCE inflation was 2.9% in August, up slightly from earlier this year, as rising core goods inflation has outpaced continued disinflation in housing services. Available data and surveys continue to show that goods price increases primarily reflect tariffs rather than broader inflationary pressures. Consistent with these effects, near-term inflation expectations have generally increased this year, while most longer-term expectation measures remain aligned with our 2% goal. Rising downside risks to employment have shifted our assessment of the balance of risks. As a result, we judged it appropriate to take another step toward a more neutral policy stance at our September meeting. There is no risk-free path for policy as we navigate the tension between our employment and inflation goals. This challenge was evident in the dispersion of committee participants' projections at the September meeting. And I'll stress again that these projections should be understood as representing a range of potential outcomes whose probabilities evolve as new information informs our meeting-by-meeting approach to policymaking. We'll set policy based on the evolution of the economic outlook and the balance of risks rather than following a predetermined path. And with that, thank you again for this wonderful award and for inviting me here today. I look forward to our discussion. Thank you.
Okay, stay with me. We're going to have analysis firstly from Bloomberg, then from me, then the charts. So stay with me. Here we go over to Bloomberg for their analysis. I've got some key quotes. I've got the charts. Let's see what Bloomberg has to say about this.
Moderated by the president of the NABE, Emily Kalinsky-Morris. They're going to get mic'd up and get everybody set here, get a little glass of water.
We've got Q&A. We've got Q&A. This is important.
Half hour. This is going to be interesting as we keep ears on the NABE conference in Philadelphia, live on Bloomberg.
About half an hour for questions. So
Sounds like a long time.
should have talked longer.
Half an hour from Powell. Look at this. This is important.
So let me start with, before I go to some of the questions coming in from the audience, and do use the Connect app to generate those. You have said, and you repeated again here, that there are no risk-free paths for the Fed now. So in light of that, and in particular, with where the recent inflation data are running, let me group this with some of the questions that we're seeing coming in on the app as well. Obviously, always data dependent. But thinking about the dual mandate of maximum employment and price stability, how concerned are you that if the rate of pass-through of tariffs is slower, that might begin to look like more persistent inflation, as opposed to a one-time, as if the tariff adjustment came through all at once, and then it would be quite clearly a one-time price level shift?
So that's certainly a risk. As I mentioned, there really isn't a risk-free path now, since it appears that inflation is running above our target and appears to be continuing to increase quite gradually, but increase. It's still on the way up. So there's a risk there that would lend to greater persistence. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So, those two states of affairs for our two goal variables, call for different monetary policy responses. So, as they come more into balance, I think the idea has
markets aren't crashing, they're not pumping. So far, I'm quite bullish on it. I'll give you my remarks in a second.
To being more neutral as those two things balance out. But it is clear, though, that if we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. And if we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things. I think for the last few months, we've been able to maintain a restrictive stance because the labor market was still pretty solid. I think that the data we got right after the July meeting showed that, which adjusted back all the way through May, showed that the labor market has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance.
Let's move to the other risk then and talk about employment a little bit. We had Anna Paulson here yesterday, and she spoke about the break-even unemployment or break-even employment growth rate, and that's a question from the audience as well. So I believe she said that it's certainly lower than it was, and the standard error around those estimates probably includes some numbers that might even be negative. Where do you see the monthly break-even employment growth rate at this point?
I'm not going to try to give you a pinpoint number, but as you pointed out, the standard error around these things is 50,000 plus or minus, something like that. And that would certainly, I think the range of plausible numbers for the break-even rate is probably does go below zero, accounting for those standard errors.
This is the most important part, is Q&A. We didn't think we'd get this. We're lucky.
And that's what's so challenging about this, is that both supply and demand in the labor market have come down so sharply, so quickly. And the fact that the unemployment rate has barely moved is kind of remarkable in and of itself, and suggests that they're moving
at the
roughly
markets.
the same pace, although, of course, the unemployment rate has ticked up, which suggests that demand is moving a little faster than supply. I wouldn't want to point to a specific number other than to say that it's come way down. And there are many, many estimates out there. By the way, there are many ways to calculate it, so you're going to get different estimates.
Take a second, hit the like button, subscribe.
So one question I have is whether you see any
Rayleigh
changes
Cordova Ruiz
in
has
the
become a
transmission
member.
mechanism of monetary policy actions. So when we speak of long and variable lags, as we do, are those changing? And in particular, do you think there might be any difference in the impacts of policy on inflation versus employment? Is one changing more than the other?
That's like 2 or 3 questions, so
I'm
I might have to
sorry.
come back to you. That's all right. So on transmission, there, in theory at least, I see 2 things. One is, what we say and the actions that we take on monetary policy and how quickly that gets into financial markets. So if you go back to when I was in college, that part would have taken weeks, months probably. And now that part happens essentially instantaneously. But the rest of it, once it's in the financial markets, how quickly does it affect economic activity, unemployment, employment, inflation, et cetera? I think that's more dependent on the conditions in the economy. For example, if you take the group of people who had extremely low rate mortgages, right? And even so, if you can cut rates, but they're a long way down, and they're sort of in a place where it's going to be expensive to move and to take out a much higher rate mortgage, even assuming significant numbers of cuts. So that has probably blunted the transmission of lower rates into that part of the economy. But overall, I think it still works the way we think it works, which is, long and variable lags means a lot of uncertainty about how it's being affected. I think the last part of your question, the lore has been that inflation and employment come later. The first decisions are purchasing decisions, hiring decisions, and things. Well, purchasing decisions, can be affected probably more quickly. But then those would eventually affect employment and inflation. So longer lags are the research generally shows longer and longer lags for employment and inflation.
Right, and I guess the variable part of that comment does give us a bit of cover.
A lot of uncertainty.
So you spoke about the adjustments or the challenges that you're facing.
Nev has become a member.
Some government data not currently being published. Beyond the headline unemployment rate, which we're not going to see right away, what other labor market indicators are you monitoring most closely to gauge that side of the mandate?
So I think everyone's looking at the same non-government data. So there's a set of non-government data around, or non-federal government data around labor markets. For example, state level unemployment, claim reports. You can add those up and get a pretty decent estimate, and that's a really good one. There's also ADP has its data in employment. So in the employment space, there's some plausible data. I will say generally, the private data, the alternative data that we look at, is better used as a supplement for the underlying governmental data, which is the gold standard, and it won't be as effective as the main course as it would have been as a supplement. So we don't expect that we'd be able to replace the data we're not getting. So I think in job, in employment space, there's some pretty good substitutes.
We're going members only chat. Members only chat is what we're going to. It takes 1 second to become a member. It's $2.99. You can still stay and watch, but members are requesting a members only chat. We're going members only chat for about 5-10 minutes, then we'll come back. Become a member. Link is in the description.
Their data
and in the live chat.
We're looking at lots of things, and we're going to make our decisions according to the FOMC schedule. But I think it will be a lot better once we start getting, for example, the September employment report is going to be a very important report, and we're not on track to have that. There would still be time for us to get that. We will get, of course, the September inflation, CPI and PPI reports. So that's a positive. But we don't comment on fiscal matters, but from our standpoint, we'll start to miss that data, and particularly the October data. If this goes on for a while, they won't be collecting it, and it could become more challenging.
Yeah. You used the term gold standard, and you didn't mean it in this context, but I'm going to pivot here because there's a question from the audience that's getting a lot of upvotes.
Oh, gold.
So one of your predecessors, Alan Greenspan, used to view the price of gold as an indicator of inflation risk. So in that context, how do you view the rally that we've seen in gold? And if you want to throw in Bitcoin, you can comment on that too.
Oh, Bitcoin.
I'm not going to comment on any particular asset price, including that one. And I think we think of
He's not happy.
Inflation as driven by fundamental supply and demand factors, and it's not something we look at actively.
Okay, fair. The September projections, we saw revised GDP growth projections revised upward for both 2025 and 2026. Now, sometimes it's just an issue-to-issue thing, but how do you reconcile that projection of stronger growth with what we're seeing in terms of a likely weakening labor market?
So even subsequent to the September SEP, we've seen economic activity data which are surprising to the upside. And as I mentioned in my remarks, so you do have a bit of a tension there between
subscribe 105,000. Can we do it?
Job creation, and yet people are spending. So economic activity is strong, and it's we're going to have to see how that plays out. Right now, of course, we're not getting any new government data on that, any new federal government data on that, but it does create, of course, if economic activity were stronger, then that would tend to support labor market activities and hiring. So we'll have to see how that works out.
All right. Another topic that has permeated the conference over the last 2 days has been AI. So as the Federal Reserve, like all of us, grapple with the implications of generative AI, what plans are in place to assess its long-term impact on productivity, implications for labor markets, and overall economic stability? And does that present any new risks to monetary policy or financial stability?
So you're right. We're doing what other people are doing, which is reading all the things that, so many researchers are working on AI now. It's just amazing. And so we follow all of that. We also have people at the Fed who are doing lots and lots of research on AI. And, in terms of, it's just such early days to be looking for the kind of things that will happen. So, the question of productivity, it was Robert Solow who said that technology is showing up everywhere but in the productivity data. So this could be the same kind of thing where it's there, but it takes a long time kind of to show itself.
Gold is pumping.
You would think of another big technological advances potentially raising productivity, but I think it's early to say that we're seeing it. Also, you're seeing, I think some researchers have found effects on hiring from AI for entry-level people and for coders and things like that. So there's probably some of that out there, but it's just so early to say what it will be. We also monitor very carefully what public companies are saying. Increasingly bold statements from mainly large private companies on things that they think they can do across their whole business area with AI, and either sort of freeze hiring where it is or reduce hiring. And I think we're pretty aware of what the potential outcomes are, but the range of potential outcomes is very broad. I will say, in terms of what the Fed can do, we deal with supply and demand. We have an interest rate, and we also do regulation, that kind of thing. But if what's needed is greater education and skills, I mean, I've always liked the model that technology can work for everybody as long as everybody's getting the skills and aptitudes they need to use that technology. This is Golden and Katz, their work, which they actually spoke about at Jackson Hole this year. But it's a 20-year-old book that they wrote. We can't do that. That's not something the Fed can do. We also can't address the potential societal disruptions that could happen, potentially, if there's really significant job loss. Mm-hmm. So there are a lot of, we're the least of it. There are potentially really significant implications for people in the labor force. And I think we're all speculating about what those might be, but it's only the beginning of this story.
Thank you.
To become a member, link is in the description and in the live chat.
Voted, and you can get as far into the weeds as you want, but this is where people want to go. So let me try this one. As you think of the appropriate level of reserves in the system, what indicators are most important? Is it the price of money, so repo levels, or the volume of borrowings from the Fed, like the discount window, and so on?
So we have a nice spider chart and 5 main indicators, one of which is sort of repo levels. And I think overall what they're showing is that we're still at ample reserves. Abundant reserves. We're still at abundant reserves, meaning above our goal of ample reserves, a little bit above ample reserves. So, but we're beginning to see, you're starting to see a little bit of tightening in money market conditions, particularly repo rates have moved up. And those are the things we're going to be watching. So we think we're still at abundant, and we're, the pace of runoff is now very, very slow. So we're going to be watching all those factors very carefully. And we're not so far away now, but there's a ways to go.
Okay.
General public in comments once again. Make sure you hit the like button, subscribe.
So I'll try to again group some of these together. First, there's definitely appreciation from the audience in your ability to try to remain above the political fray, and I think also, and as in your remarks, you said gradually and predictably, and that sounds really nice right about now, but. With that ongoing scrutiny of the policy decisions of the Fed, what measures is the Federal Reserve taking, and are you taking, to ensure and demonstrate the continued independence in setting monetary policy?
So the main thing we can continue to do is to do our work the way we've always done it, which is, think really carefully about evolving economic conditions and the evolving outlook and the balance of risks, and try to make good decisions to best serve the American public, and then explain those decisions and talk about them in a way that makes sense and is grounded in the data and our overall approach. I think we're going to keep doing that, and as long as we're doing that, people will be able to tell. If we start doing something else, I think people will be able to tell that too. But that's just not something we're ever going to do. We're always going to keep doing our work. We don't engage in back and forth with people. It's just not, that gets to be political sort of right away. So we just do our work and do it as best we can. Overall, I would say the Fed comes through the last, if you think about it, go back to the beginning of the global financial crisis. We've had 2 world historical crises back to back, essentially. And the U.S. economy, it's been quite a ride for the U.S. economy and for American citizens, but we've come through it as well or better than any other country in the world. And we had to innovate and did innovate. There was really no choice. We can look back now and as I did today, and second guess ourselves, which is only appropriate. We've been doing it for 10 years. Since I got to the Fed 12 years ago, we were already doing a lot of that. So that's an ongoing process. But I think if you take a step back, the Fed is a government agency that does a good job for the public that it serves, and that is our only goal. And I think we do it pretty well. Don't look for perfection. You know, these are close calls that have to be made in real time. But I guess that's what I would say.
It's fantastic. And in that context, then, internally to the FOMC, how important is it that you have consensus on it? I mean, we're economists. We understand the value of spirited debate, and but is that important in terms of communicating the results and the decisions of the committee?
I mean, consensus is great, but I mean, the most important thing of all is to get it right. Mm-hmm. And you know, that you come to places, not very commonly, but sometimes you come to places where people are going to have different views, and this is one of them. You have a situation here where literally inflation's above target and gently rising. The labor market is subject to pretty clear downside risks. What do you do? How do you think about that? That's not a problem that you face very often in central banking or in the economy, and people are going to have different weights and different risk aversion and different risk appetites on those things. It would be kind of surprising if you had no debate over those things. So we have a healthy debate going on. I think it's very healthy. I think the meetings that we've been having are as good as any we've had, you know, in terms of people sincerely, you know, giving their absolute best argument for their positions, but they're different positions. That's, I mean, when I was an investor, I always felt like the most dangerous thing is if everybody agreed on something, because you need someone to come in and try to explain why this is a terrible idea. Hopefully somebody really smart. And that would give you the ability to really test your thinking. So I think that's a healthy discussion that we're having right now. And I'm not at all surprised.
Stay with us to the end. We'll analyze this. We'll look at the charts.
We also, as an institution,
stay with us till the end.
Come together around you know, a central answer, and that's of course part of what I try to do is you know, find an answer that will attract as much support as possible.
Absolutely. I know you probably won't want to comment in great detail on global conditions, but there are a few questions around that and what that implies for U.S. monetary policy, and also just looking at the interest rate differentials between the U.S. and other advanced economies.
Someone asked, are we at 105,000? Not yet. Not yet.
Is there a risk there?
Sorry.
The interest rate differentials between the U.S. and other advanced economies.
Yeah, I mean, you know, we set interest rates according to, you know, the place where our economy is domestically, you know, taking into account the international aspects of our economy. So again, it's not surprising. I mean, you could name many factors, but, you know, for example, tariffs are clearly more disinflationary for countries that are subjected to them, and they're more, I won't say heavily inflationary, but there's some inflationary pass-through to consumers from countries that are putting tariffs on. So there's a very different monetary policy response potentially just in that. So, you know, I think we need to set, as every other central bank does, they're setting rates in whatever their, you know, remit is geographically, and they're going to be different answers. It's not unusual.
So we have a large number of young economists in the audience today. Could you talk a little bit about, as we look back, and, you know, it's a momentous award, so a nice time to reflect. If you looked back on your early career and your early goals, how do you think that young Jerome Powell would view where Jerome Powell is sitting today as chair of the Federal Reserve?
Surprised. No, I would say, so what I would tell young economists is, you've chosen a great profession, a tremendous profession. You know, you're getting the tools to analyze public policy and what works and what doesn't work, and what should be expected to work and wouldn't, and why. And also, what's the state of the economy? And guess what? It's not just hard, it's basically impossible. But it's a very, very difficult thing, but it yields itself up over time. And you know, it's just an incredibly important subject that carries the capability to do really good things for the general public, who may not feel great gratitude toward economists, but sometimes. But no, it's really important. You've made a great choice, and I would say, wish you the best of luck.
Thank you. Agree. Okay, we'll do a little bit of a lightning round here. We have about 5 minutes left, so I'll ask a bunch of questions that you may not want to get into great detail on anyway.
After 5 minutes, we're going to do our analysis. I'm going to tell you exactly what I think. We're going to look at the markets as well.
Some of these are pretty straightforward, but so we talked quite a bit about labor markets, but we have not specifically asked the question about the effect of immigration policies on labor supply. How restrictive do you think that current policy is, and is that something that will just
current immigration policy?
Yeah.
Yeah. Let me start by saying that we don't have a view on immigration. It's not our job to have a view. So we take that as completely, you know, it is what it is. We take it as it arrives. More, I'd say, a stronger policy than most people had expected. You know, we've seen you know, very sharp decline in growth of the labor force and in people entering the country, and yeah, I think you're only beginning to see the strength of that policy too. You know, there's more expulsions; those are rising, and that kind of thing. So yeah, that's a big economic factor. So that will mean, you know, fewer people to work. You have anecdotal evidence of industries that are just having a hard time finding people. You don't see it in wages or anything like that at this point. You don't see, at least in the aggregate, you don't. But yeah, it's going to be a really important economic fact because that, you know, that's new people who come into the workforce. They create their supply, but they also create demand. They create their own demand, and you know, again, from our standpoint, we're just, you know, our job is to achieve maximum employment or maximum sustainable employment. And that will depend both on the supply of workers and the demand for workers.
Back to the balance sheet, some questions, again, I'll kind of try to group these together around mortgage-backed securities and housing affordability. Again, not directly part of the dual mandate, but would the Fed ever look at any specific actions with regard to MBS to address mortgage rates or affordability for housing?
The answer is, look, we look at overall inflation and we don't target housing prices. And also I don't know how you would, we would certainly not engage in mortgage-backed security purchases as a way of addressing mortgage rates or housing directly. That's not what we do. We do have, as I mentioned, a very large amount of mortgage-backed securities, and they're running off, but they run off pretty slowly. So.
Fair. Question on the beverage curve. Maybe that's not a lightning round question, but let's try it. So do you think that the shift in the beverage curve is a structural shift or just a blip?
I think it's, you know, you're at a place where, you know, further declines in job openings might very well start to show up in unemployment. You know, you've had this amazing time where you came straight down, and but you know, I just think you're going to reach a point at which unemployment starts to go up, and we haven't really, we may be hitting that now, but it's been remarkable how that line, it just comes down, and which has been, you know, really a great part of the recovery.
All right. Well, we have just a couple minutes left. I think we'll end with maybe another sort of philosophical question. Michael Barr spoke to the policy conference in 2024, I believe it was, and he gave some advice to economists. What would your advice be to the economists in the room in terms of how we can best serve the challenges that are facing us collectively in this moment?
I'm inclined to say keep your heads up. You know, it's a time when people are challenging expertise, and you know, I think it's a distinguished profession. It's a very high order profession, and you should be proud of your work and keep at it. I mean, ultimately, we're learning about how the economy works and how society works. Our understanding is so basic and so uncertain, really, still after all these years. But, you got to think we're making some progress and doing some good, and imposing sort of an analytical framework around the kind of decisions people make about the economy. So I just want to give you a vote of support and say keep at it.
And likewise, NABE supports you.
Uh-oh. Are we done?
I think we're done. Thank you so much.
Thank you. Thank you. Thank you very much.
There you have it, live in Philadelphia. The chair of the Federal Reserve in conversation.
I'll give you my
with the
analysis now.
National
1 second.
Association of Business Economics, live on Bloomberg. I'm glad we could bring that conversation to you, as it generated a lot of headlines. The Fed chair saying the outlook has not changed much since the September Fed meeting. Powell went on to say that labor market perceptions remain on a downward trajectory. This was not the most upbeat speech. Referring to the balance sheet repeatedly, it was a big central focus in this conversation. The Fed may end the balance sheet runoffs in the coming months, he said, with a Fed more nimble in its use of the balance sheet. Talked about the labor market showing significant downside risks, persistent tariff inflation, another risk, saying that inflation is still on the way up. With regard to missing data, we're going to talk to Molly Smith about this live from World.
Okay, we've got our own analysis time to analyze it. What we're going to do is go into members only mode. I'm going to give you 5-10 minutes of analysis. We're going to do the charts. We're going to look at the major charts here. We're going to look at Bitcoin, the S&P 500. I'm going to tell you exactly what I took away from that Jerome Powell speech as well. We're going to go into members only mode. Right now is members only mode. You can still stay and wait for the analysis. Anyone, if we get 10 people to become Electrum members, that's our newest, best membership, in my opinion. A lot of it is at our cost. What we're doing is every Sunday we're having an Electrum event, which means you're going to get educated about the markets. You get to go one-on-one with me as well with the charts. So any question you want will be answered. If anyone becomes an Electrum member now, if we get 10 people become Electrum members, remember you get all the perks of bronze, all the perks of silver. If we get 10 people become Electrum members, we will do an Electrum show today for you guys, and I'll take notes of your names and we will get your requests done. All chart requests, full chart requests. So the link is in the live chat. If we get 10 people become Electrum members or upgrade to Electrum membership, remember you get all the perks of bronze and silver, and we will do a special event just for you guys. I'll take note of your name and I'll make sure we do your chart request. So let me tell you about some things Powell said. Firstly, we're looking at Bitcoin as I've looked at through my notes. Bitcoin is is quite positive after this reaction, after the speech. We can see the S&P 500 has actually turned green now, up 0.35%. Gold started going up up to 1%. So the market is taking the speech quite well. Some of the key messages Powell put forward, what were they? Well, he said, we judged it appropriate to take another step towards a more neutral policy stance. So that does signal it's the end of the tightening cycle. He's confirmed that now, and is now focusing on balancing risks. He also said something about the jobs market. He said to us, what was the quote? Further declines in job openings might very well start to show up in unemployment. So employment growth is slowing. Labour participation is down, and Powell admits unemployment may rise soon. He basically admitted unemployment is going to rise soon, meaning we are expecting rate cuts. He doesn't want to be left behind. That by itself does indicate rate cuts are to come. He's also talks about soft landing. So Powell praised how far, when he was talking about the beverage curve at the end, fell, fewer openings without layoffs, but that phase is ending. So that phase where fewer openings without layoffs is ending, meaning the soft landing is coming to fruition. Remember, the soft landing is what the market wants to see. We don't want to see a recession, and we don't want to see inflation holding up. He then talks about inflation mainly tariff driven. So he did mention tariffs. Remember, at the end, he was talking about tariffs. He said the August PCE was at 2.9%, but Powell stressed that prices increasing stem from tariffs, not broader demand pressure. So he's blaming that on tariffs, but he's not saying that's demand pressure. So that's actually not too bad, because he has mentioned before that inflation is a sort of a one-time hit, and then you get on with it. So if he's saying that inflation is coming from tariffs rather than broader demand, that's actually a good thing. So that means the Fed is not going to overreact to tariff inflation. So if we see inflation being sticky or inflation go up slightly, he's basically said there he is not going to react to that sort of inflation. He's prepared for that, he expects it, but he's not worried about tariff inflation. That's a big, big signal he sent to the markets there. What else did he say? Well, he said the Fed now views the balance of risks as tilted towards the labor side. First real acknowledgement of slowing momentum. So when he was talking about employment, he's basically saying the employment risk, and this is why we're looking at the S&P 500 rallying right now to the highs of the day, is because he's saying that employment risks outweigh inflation risks. That's what we wanted to hear him say again. Remember, this is what he said at the Jackson Hole event, which caused the markets to go up. So he is basically saying that the risks to unemployment are bigger than inflation. That is a signal of rate cuts. Oh, Nav has upgraded to Electrum. Congratulations, Nav. We've got 9 more people. If they upgrade to Electrum, we will do a special show, and I'll do all your chart requests. I'll take notes of your names. Nav, I think you just became silver and you decided to upgrade to Electrum. Congratulations to you. Anyone else who upgrades to Electrum or becomes an Electrum member, I will take down your name so we can do a one-on-one later. Again, that's only if we get 10 Electrum members before the show ends. So let's continue. He also said he's not helping the housing market. Powell says the Fed will not buy mortgage-backed securities to lower mortgage rates. That's not what we do, he said. So he is not looking to help the housing market or encourage or back up the housing market in that sense. He then spoke about immigration. This is on the quickfire area. He said immigration equals positive supply and demand. New people who came into the workforce create their supply, but also create their own demand. Powell defends immigration's economic benefit. So he was saying that immigration is net positive on that question as well. He also talked about policy flexibility remains. Again, that's something else he mentioned as we're talking. The S&P 500 is trying to make the highs of this day. Again, I'll go through these charts after I finish up with his remarks. He says, we'll set policy based on the evolution of the outlook, not a predetermined path. That's basically keeping the door open for future rate cuts if labor data weakens further. So everything was slightly indicated that he is looking to cut more rates. He is dovish, but he's cautiously dovish. That's the tone I took away, was him being cautiously dovish. So he acknowledged risk to jobs. Inflation, he said, is under control. Tariff inflation doesn't really care about. And the economy is firm. He said the economy is in a very, very good place, but it's softening. So the takeaway is it's bullish for risk assets, stocks, crypto, gold. I would say that speech overall was bullish for the markets. He then he does then signal slower growth ahead and unemployment ticking up, but all of that does suggest that rate cuts are coming. In the sort of the first part of the speech, I took some other notes as well. Let me see if I can bring that to you as well. So a few quotes from earlier. He was saying, we judged it appropriate to take another step towards a more neutral policy. So he confirms that the Fed sees it prior rate cuts, remember the one at September when he did 25 basis point, they see that as part of a gradual normalization process, signaling the tightening cycle's over. So again, when he says we judged it appropriate to take another step forward towards a neutral policy stance, he is suggesting, and remember all of these words, especially from his speech, this part's from the speech, very carefully worded, and how this sentence is worded, where it says another step towards a more neutral policy stance, that to me is suggesting this is now a normalized stance of continuing to cut rates towards a continuing cutting cycle, and that this is normal now. We're going to start seeing more and more cuts. The Fed is easing its foot off the brake, supportive for liquidity and markets. So another quote he said was, rising downside risks to employment have shifted our assessment on balance of risk. Powell is saying that the jobs market weakness now outweighs inflation worries. A clear pivot in priority towards supporting growth. So that again is bullish for the markets. Again, rate sensitive stocks, tech, housing, crypto. When he starts saying that the downside risks to employment have shifted our assessment of balance of risk, to me, again, that is a bullish indication for the markets. He also said good price. And again, we're looking at the S&P 500 here rallying. The Bitcoin rallied and sold off a little bit, but now it's looking like it wants to rally once again. Again, as I say, I think this is quite bullish for the market, so I expect the market to continue going up. He said goods prices increases primarily reflect tariffs rather than broader inflationary pressures. Remember, if you are watching, it takes 1 second to hit the like button. It takes 1 second to subscribe. You're watching for free. You can hit the like button for free. You can subscribe for free. Thank you to all our members. Remember, the members are the ones that keep us going. The money to support the show is made from the memberships and the super chats, not from going live. Anyway, we're now at 104,760 subscribers. Let's see if we can get to 105,000 during this show. If you do want to become a member and support the show, the link is in the live chat. I'll put it in for you again. We are in members only mode. We always reply to all members' comments. And also, if anyone becomes an Electrum member, the next 10 people or the next 9 people, we've got someone who just upgrades to Electrum. I'll take note of your name. We'll do a special Electrum show tonight. Let's see if we can get another 9 people become Electrum members. So goods prices increases primarily affect tariffs rather than broader inflationary pressures. So what he's saying there is now we're seeing goods prices go up, that is not inflationary pressures. That's because of tariffs. Again, yes, it's the same thing as inflation, but it's a very important distinguish. You have to distinguish them very importantly, if that makes any sense. What I'm trying to say is tariffs are separate to inflation. They are sort of obviously cause the same thing, but he's regarding them in 2 separate ways. Broader inflationary pressures are more concerning than tariff inflation. Tariff inflation, yes, it does come through to the consumer. It's more expensive for the consumer. Not many people can argue against that, but it's more a one-time thing. If the Fed thinks it's a one-time inflationary pressure, they don't really care about it because they go, well, what we're going to do, it's a one-time thing. We're not going to adjust our policy just based on how tariffs affect inflation once. So he did say that the goods prices going up right now is actually due to tariffs, not broader inflationary pressures. You might think that's a bad thing to say, but it's actually a good thing to say. Why? Because he's saying that he's separating tariff-driven price spikes to domestic inflation. They're more worried about this domestic inflation because that's more concerning, implying inflation itself, the normal broader inflationary pressures itself, is not re-accelerating. That's not why inflation is staying sticky. It's staying sticky because of tariffs, and that is not a something that we expect to continue. It's a one-time inflation hit. So what he's saying here is the inflation is caused by tariffs. That's why we're not concerned about inflation staying quite sticky. So it's suggesting that the Fed won't overreact to tariff-related CPI noise, you can call it. Also, there is no risk-free path for policy as we navigate the tensions between our employment and inflation goals. That's another quote from Jerome Powell during his speech. He says, there is no risk-free path for policy and we have to navigate tension of our employment and inflation goals. So again, this is where he's a bit more hawkish. He says, that's a caution note. He is showing that there is uncertainty in the market. He is reminding markets that the Fed have a balancing act. Remember, this picture over here this is what we're expecting. Inflation, employment, it's a balancing act. Remember, this is from our very own newsletter. This was a deep dive today. Everything you need to know about the speech today. You've got the timings of everything important as a economic calendar, earnings, data, when everything's coming out. You've got the charts every single day. Today's was on gold. You've got the top stories at a glance. So even if you're looking at your phone for 20, 30, 1 minute, you get to see all the top stories today. Stay ahead of the curve. No ads. Very easy to access. You've got the one big thing, the market snapshots. It takes 1 second to subscribe to our newsletter. The link is now in the chat, whether you're a member or not a member. Anyone can access this link. If you want the premium membership where you get access to the one-on-one, you get to DM me at any time of the day. You get access to the to the community, access to all the deep dives, access to members only posts. It's 30 cents a day. Give up a coffee once a week and you get access to the best newsletter, I believe, for markets. If I had access to this, I'll be paying a lot more. But obviously now, because we didn't find anything as good, we made it ourselves. So there is a newsletter. Do consider subscribing. There is a free trial if you got for the yearly plan, or there is a free plan where you still get access to all the top stories at a glance as well. So definitely worth subscribing to the newsletter. The link is in the live chat. It's also the first link in the description. Let's continue, and then I'll go through the charts. And then in 10 minutes' time, we've got Vaz going live. So let me just see if we've got any update from Vaz. He is going live straight after this. Yep, Vaz will be going live in about 10 minutes' time. So get ready. Let me give you the final analysis, my charts. If we get another 8 people become Electrum members, we'll do an Electrum event. So stay with me. The membership link is also in the chat. Let me just make sure the markets, the markets are reacting well. Our analysis is correct. S&P 500 is moving up once again. Okay, so there is no risk-free path for policy as we navigate tensions between employment and inflation goals. Remember, this is where he addresses both sides of it. He addresses that there is uncertainty. He reminds the markets that the Fed is balancing, not committing to a full-blown dovish pivot. That's more of a neutral tone where we were expecting to be a little bit neutral, but he does seem a bit more dovish in this. We will set policy based on the evolution of economic path and the balance of risk rather than following a predetermined path. That's another quote from Jerome Powell. That reinforces his data dependence, but obviously the key data is delayed because of the shutdown. I think they'll just continue cutting rates. So let me give you my full analysis now. Let me go to your comments as well. I'll come to all members' comments in a second. So if you have just become a member, or if you are becoming a member, the link is now, that's the newsletter link, and here's the membership link. I'll come to your comments just after I give my final thoughts. So market's going up. I am quite bullish based on that reaction. I am now going to be very confident in my prediction now. I think we're going to get a rate cut on the 29th of October. Join me for the FOMC meeting. This is what we've been predicting. Rate cut in October, rate cut in December, potentially a rate cut in January. We've got 2 now confirmed, in my opinion. 2 out of 3. 2 out of the 3 next Fed meetings. I am very confident now that we're going to get 2 out of 3, maybe 3 out of 3 rate cuts. So join me on the 29th of October. I'll be covering the FOMC meeting live. Make sure you're subscribed and you've got the notification bell on. I think we're going to get a rate cut in October. I think we're going to get a rate cut in December. And I think we might get a rate cut in January. That is also what the market is pricing in after today's speech. I think that this rally can continue unless Trump comes out with a tariff situation, more tariffs. I think that could put the market down. We are very overbought in the markets, and we've got earnings coming up. If you want to book your earnings, this is a reminder for you. Remember, we cover everyone's earnings if you do a super chat. A $10 super chat means we will spend a couple hours covering the earnings, an hour analyzing the stock, all for $10. So what you can do is right now, you can do it as well, or you can do it in Vaz's shows. You can do a $10 super chat and tell us your favorite company, ones you are invested in because you want to listen to the earnings calls. We're coming into earnings season. That's very important for the broader market. That's very important for individual stocks. Do a $10 super chat and we'll cover the earnings for you. Tomorrow, we've got ASML. We're covering that. If anyone does a $10 super chat, we can look at Bank of America. There might be a link there with crypto and XRP. That would be a great one to cover. If anyone takes a second to do a $10 super chat, we'll do Bank of America tomorrow morning as well. We've got United Airlines tomorrow. That's a very interesting one as well. I know Vaz would love to do that. If you guys do a $10 super chat, we'll do United Airlines tomorrow as well. We've got Interactive Brokers on Thursday. Friday, we've got Amex. If there's any other ones you see, you can always do a super chat for. Coca-Cola on Tuesday. I'm sure someone wants to book that in. What else do we have? We've got Netflix after hours on Tuesday, Tesla after hours on Wednesday. Remember, it's first come, first serve. Once it's been booked, we can't really do more than a couple earnings. We've got Thursday as well, Intel. Friday, we've got Procter & Gamble. Then it gets very heated. This is when you need to start booking them in now. We've got Thursday, which has got Lilium, MasterCard, Apple, Amazon, Coinbase, MicroStrategy, even more there. So it's going to get very, very busy. eBay on Thursday. We've got Microsoft, Meta, Google, Starbucks all on Thursday. Earnings season is coming up and it's and it's rapidly going up. Why is earnings so important? Well, the price to earnings ratio on the S&P 500 is overinflated. What do I mean by that? It is very high. It's about 22, 23, 24 times earnings. That is very high historically. To bring it back to normal levels, we need a 20-30% crash. To go undervalued, we need a 30-40% crash. And if that happens, we've just got a super chat for Bank of America.
Donated $10 through a super chat. Bank of America earnings, please.
Bank of America earnings. Donda, I will write it down. Bank of America earnings for Donda tomorrow. Let's see if we can do it. We've got two running at the same time. That means now tomorrow morning. I'll try my best to cover both. Donda. Okay, thank you for that, Donda. We will do Bank of America. So S&P 500 is severely overvalued. It needs to crash maybe 20-30% to come undervalued. Or earnings needs to beat. If earnings beat and we grow into those valuations, maybe earnings beats. But we still probably, if we have amazing beats on the S&P 500, we probably still need to go down 10% to go to fair value. That's why I'm not overly bullish on the S&P 500. However, the Russell altcoins, they have plenty of room to run. I think they can pump one more time into your euphoric run before we get a proper crash. Again, no one knows when the final crash will come. Maybe it's already started. Maybe it hasn't. I'm still in. If it crashes, I'll just buy lower. If it goes up, I'll take advantage of the massive move towards the upside. This speech does help that. This speech does take us to those, gives us a chance to go to all-time highs once again and get that money flowing from the major caps such as the S&P 500 into the less quality, higher risk tokens such as the Russell and the altcoins. So the speech today went well. Congratulations, anyone in the market. You've made some money today, even if you bought on the lows today on the S&P 500. We are now up from the lows today. We are now up about 2% from the lows today on the S&P 500. So congratulations to you. I'm going to go over to the members' comments now. Did we? I don't think we got anyone else become an Electrum member. Here is the link to become a member. All you have to do once you hit this link is, we did. Izen became Electrum. Congratulations.
IZ has become a member.
Can we do it? Can we get 7 more people to become Electrum? We've got 5 minutes. Can we do it? All you have to do is press this link. You can cancel it. If you don't like it, you can cancel it, but I'm sure you will love it. You can press this link. It will take you to this over here. If you're on an iPhone, it won't work. But if you're on a laptop or if you take that link and press on your iPhone and go to Safari and go to browser, to desktop version, what you'll see is this page here. You can press upgrade. Once you press upgrade, you can go to Electrum. If you haven't joined yet, it'll probably have a join button next to the subscribe button where you can, over here, where you can see. If you press join, you become an Electrum member. I'll take note of your name and we can do one-on-one chart analysis for you in our next event. If we don't get the next 8 now, I will make sure the next event we will take care of you. So this was our event from Sunday. Actually, let me just play this. This is what we were doing on Sunday. We did a fun trivia quiz. There was only about 20 of us there, so we answered all your questions, did all your requests, and also learnt a lot during the trivia, gave away prizes as well. Let me just give you a few clips. Who is loaded, by the way? The crash. The broader crypto market's total capitalization fell from around 4.2 trillion to what? what was the market capitalization after the crash? From 4.2 to 2.5 to 3.7 to 4.5 or 3.3 trillion. Here we go, 2 seconds. Oh, Loaded, you're there. Sorry. Just a random member. Sorry, Loaded. So there we go. That was the event. See you in the chat. You can see the leaderboard. Who got that right? Who got that wrong? Loaded is. Let me go to when we saw the winners, and then we went into all chart analysis. Rene is on the podium. Enough. Number 3. Electrum Podium Week 2. Number 3. Rene Zanin. Rene is on the podium. Number 2 is Loaded, which means number 1. Is it Christopher? Or did he get it wrong? It is Christopher Pennington. He is number 1. Oh my God, look at that. That was great fun. Then we went into chart requests. We were doing all sorts of chart requests yesterday, on Sunday night. A lot of analysis there. So do become an Electrum member. Lots of cool perks, as well as all the silver, bronze perks as well. Loaded is in the chat. Congratulations, Loaded, for being number 2 in that. Sorry, I forgot who you were. Anyway, we're going over to Vaz now. I'm live every single morning, 2 hours before the opening bell. Tune in tomorrow for some more analysis. Every single morning, we go through all the top stories from the newsletter and extra analysis. We're going over to Vaz now, who's starting. So let me give you the link to Vaz. Everyone needs to go to Vaz. And make sure you tell him that I sent you. It's on the same channel, but it's Vaz going live now. So if you click on that link and say Sensei sent me, stay there, say hi to Vaz, see what he's talking about. He's talking about the very, very interesting eVTOL sector. He's got a big story today about an industry that can start pumping on their first flight. Horizon Aircraft new partner, Hoverstock. We've got a very interesting story. To go over there, hit the like button, say Sensei sent me, learn about eVTOLs, find taxis. They're coming to a town near you. And this is like Tesla in the early days. Not many people believed they will succeed, but they're coming. If you actually understand the technology, which Vaz does, he'll explain it to you. They are coming. eVTOLs, flying taxis, we can call them. They're here to stay. So we analyzed Jerome Powell. Everything looks bullish. Now we're going over to Vaz. He is starting as soon as this show ends. It might say it's starting in 4 minutes, but he'll go live as soon as I send you over. So Vaz is going to start his live now. I'm going to send you all over to Vaz. I'll be back in the morning. Thank you for tuning in. Remember, any key event, whether it's Jerome Powell, whether it's people, Congress talking about crypto, whether it's every single morning we go live, I'll give you all the times in case anyone doesn't know the times. If I go onto my X and I'll bring you over my timings, just so everyone knows when we do our daily show, because this is not our normal time. Every single morning, 7:30 Eastern Time, 12:30 UK time, 1:30 Central European Time, 5 p.m. in India, 8 p.m. in Singapore, 8 p.m. in China, 9 p.m. in Japan, 10 p.m. in Sydney, 4:30 p.m. Pacific Time. You can always watch it back if it's too early or too late for you. But those are the times every single trading morning I go live. So do tune in, say hi if it's your first time in one of those events. But now it's time to go over to Vaz. Thank you everyone for tuning in. Sensei sent me, oh snap, wrong video. Yeah. Did I give you the right link? Yeah, I did. Yeah. So that link takes you over to Vaz. So let's go over to Vaz. Thank you everyone for tuning in. It's been a great show. It's been a great speech, actually. We'll be back tomorrow. Go to Vaz. This video will take you directly there. Say Sensei sent me. Until next time, take care of yourselves and each other. Bye-bye.